we all feel like even though stocks are going up and our 401k is going up, nobody's getting any richer. Okay? We all know this intuitively, that we're not actually getting richer because the stocks I sell doesn't buy me more of a house. So what was the point of buying the stocks?
Raoul Pal begins by explaining how, since the 2008 financial crisis, the global financial system has been effectively managing its own bankruptcy through what he calls mutualizing the bankruptcy. This process occurs via the debasement of currency, primarily through a mechanism known as quantitative easing key. Instead of raising taxes to cover debts, governments and central banks opt to print money. This printed money dilutes the value of the existing currency, making it appear as if asset prices are rising. However, in reality, these prices aren't truly increasing in value. They're just reflecting the reduced purchasing power of the currency. To illustrate this, Raoul suggests examining asset prices not in nominal terms in US dollars, for example, but relative to the central bank's balance sheet. When we make this comparison, we notice that major asset classes like the S&P 500, real estate, and even gold have not truly appreciated in real terms. The only assets that have genuinely outperformed this debasement are cryptocurrencies and technology stocks. Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comment section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
What we are doing since 2008 is mutualizing the bankruptcy of the system via the debasement of currency. You can either raise taxes, which they're trying to do too, but they're also printing currency via the mechanism called quantitative easing, which is actually debasing the currency, which means that every time they do it, asset prices optically rise. They don't actually rise. Because if you look at the central bank balance sheet and divide all assets by it, so you're changing the denominator, it's normally US dollars, but when you use the balance sheet, you say, okay, this is the purchasing power of dollars. Now, how many dollars are in the economy or excess printed? And what you find is something like the S&P 500 has gone nowhere. Real estate, gold, gone nowhere. And there's only two assets that have actually outperformed, which were crypto and technology. Okay, which is why we all feel like even though stocks are going up and our 401k is going up, nobody's getting any richer. Okay, we all know this intuitively, that we're not actually getting richer because the stocks I sell doesn't buy me more of a house. So what was the point of buying the stocks if the value of my assets aren't going up? But that is a mutualization, which is bad because it mutualizes it amongst people who don't have assets. So you'll never be able to buy an asset, which is why when you speak to a millennial now, they're like, we can't afford a house. Why? Because they came in to the labor force after the Fed started monetizing or lowering the value of the denominator. So property's got more and more expensive for them. It's impossible for them to buy property really, unless they're really lucky in the workforce or in entrepreneurship or whatever it is. But generally speaking, it's become impossible. And everything has got more and more expensive, assets have, because of this optical illusion. But wages haven't gone up, remember, right? That's the key thing. Assets are going like this. We were doing this before because of demographics, and it was making people pissed. And now we're doing it from debasement, and there's no way around it. So what debasement does, on the other hand, remember, it makes the price of assets look like it's going up. This is why you can't have a banking crisis of the order of magnitude that existed before 2008. The reason being is you just print money the moment you see it, and voila, everything goes up. So the value of your collateral, so if you think about a debt, it's collateral plus the debt, and the collateral is what guarantees the debt. If you've got a banking crisis, your collateral is often falling so fast that, like commercial real estate, right? We're going to have a problem with that. So there's a bunch of debt, and the banks have got this commercial real estate as collateral, and it's all bloody empty, and everybody's going to try and get out of it. So the answer to that is print money and essentially magic that collateral higher, or put it on the central bank balance sheet. Europe has already done this. So I don't think you can have a systemic collapse because the value of the assets can never go down enough. All private sector households. So how does the average person service the interest? It's again from economic activity, the activity that they have. So the same with corporations, and the banking system is involved intricately within that whole system. So economic activity is what pays the interest. If you don't have a job, you can't service your mortgage or your credit card, right? Fact. And if your debt growth keeps going up, you need to keep your wages going up to pay your debts. That's the GDP side of the equation. But what we're finding is that all debt that is in excess of GDP at government level is ending up on the balance sheet 3.5 years later. And I did the maths on this, and I think I was the first person to really figure, I don't think anybody's really figured this out yet. I went and looked at this, and I realized that what they were monetizing was the interest payments on the debt 3.5 years later. Okay, why 3.5 years? In 2008, all interest rates went to zero. Every government refinanced itself at zero. And most of the debt for all governments is in the 3 to 5 year sector. So somewhere between 3 to 5 years, 3.5, 4 years. And what happens is every time you service the debt, you need to get the interest rates back down again. You end up having a recession. You get this very cyclical phenomena.
Pal brings attention to a critical insight: that most debt at government levels, which exceeds GDP, ends up on central bank balance sheets around 3.5 years later. After the 2008 crisis, when interest rates were slashed to near zero, governments refinanced their debts at these low rates. Because a large portion of government debt is issued in the 3 to 5 year maturity range every 3 to 5 years, there is a need to roll over this debt at current interest rates as economies slow down, largely due to the burden of servicing these debts. Central banks often step in to buy the debt, adding it to their balance sheets. Pal identifies that this process is happening everywhere, including Japan, and shows no signs of stopping. The effect is a continuous cycle of money printing, debt growth, and balance sheet expansion. He points out that during financial crises, direct money injections are required, further increasing debt levels and perpetuating the cycle.
Nobody pays back debt. Nobody. Nobody is paying back any debt anywhere. So what they're doing is every time it comes to pay to service the next amount of debt, it ends up on the Fed balance sheet. Now, it actually happens because there's an economic slowdown driven by the debt, but that's what happens. And there is a marginal difference in the size. This is true of the US, the UK, the EU, Japan. They're all the same. And the difference of the balance sheets is slightly bigger. And the difference is every time there's a direct financial crisis, they have to put direct money in. The government is borrowing the money here, right? So what they just pay off. They don't pay off the debt. They just do it again. So it's like your mortgage comes up at the end, and imagine you just had interest payments. You just roll it again and say, oh, I'm just going to pay interest for another 30 years. Nobody ever pays off the actual loan. And nobody cares as long as you get the interest. So debt is growing in all of these countries at GDP plus the interest payments. And that interest payment component is going on the balance sheet. And that's happening everywhere, including Japan. So they're all doing exactly the same thing. I think we are at economic warfare. Everybody needs an enemy. So we've decided that China, Russia, whoever we want to be our enemy is our enemy. So we are economic warfare for the share of the pie. But the world is not, it's not actually a fixed pie. There's an abundance. And that abundance is the other economic warfare, which is technology. But that's happening at a massive scale. And it's going into space, it's going everywhere. So we've got physical kind of warfare, economic warfare over technology, which is what Taiwan is all about. You know, they own the secret code, which is the ability to produce computer chips in ways that nobody else can replicate. So there's that. The thing that's actually driving the S&P 500 is the Fed balance sheet. It's an optical illusion. It's a money illusion. And so then when you understand that, and it's 97%, you understand that nothing matters apart from this liquidity, which is what I've been trying to tell people, is sorry, all your economic models are wrong. Yes, you need to forecast the business cycle to know where you are in the probability of printing money cycle, but that's all that matters, and it drives assets. And that's why people right now are getting very angry because the stock market's going up, and they're like, yeah, but don't you know there's a recession? Yeah, I know that the answer to a recession is more cowbell, printing of more money. The important point being here is, I know what drives liquidity. It's driven by the business cycle, and there are certain cycles that are forward-looking. The Chinese credit cycle happens to lead by about 18 months or 2 years. The business cycle is the ebb and flow in economic activity that occurs, and that's a boom and bust, a recession, expansion. We don't really know what causes the business cycle. It's caused partly by interest rates. It's caused by excess production, excess inventories, too limited inventories. There's many things that can drive a business cycle, but it's observable and has been observable for millennia. And one of the things we do is when the business cycle is too hot and inflation starts rising, central banks tend to raise interest rates. That tends to bring down economic activity. I think even without a central bank, interest rates would rise naturally, because I think the free market can set interest rates without a central bank. And then the economy slows down again, and we see this endless cycle.
In summary, Raoul Pal provides a comprehensive overview of the current state of global economies, emphasizing the illusory nature of asset price inflation and the continuous cycle of debt that keeps economies from achieving real growth. He suggests that as long as central banks continue to print money in response to every downturn, we will remain stuck in this pattern of economic stagnation. Whether you agree or disagree with his perspective, it's clear that the financial world is more interconnected and complex than ever before. Thanks for watching. If you enjoyed this video, don't forget to like, share, and subscribe for more insights on investment strategies and financial tips. Leave your questions and comments below. I'd love to hear from you. See you in the next video.